RealAgriculture.com's coverage of the 2011 National Cattlemen's Beef Association meeting is brought to you by Haney Farms and Elanco Animal Health. Tim, right now in the markets, there's a lot of commercial activity, like hedge funds and mutual funds getting invested in ag commodities. Obviously, there's a lot of bullishness around ag commodities. There's some groups that are pushing to remove speculators from the market. From the CME's perspective, why do we need speculators in a market?
Well, first of all, keep in mind the job of the market. Okay, the job of the market is to provide capital and to bring people into the marketplace, right? And I think I saw a number not that long ago where the cattle herd was at a 53-year low. Okay, so what that's saying is it's saying that we need capital into the market, we need investors in the market, we need to bring people into agriculture. And so what's happening is the high prices that we're seeing are bringing people like that into the market. So there's long-term investors that are coming into the market. Some of those people are entering the market in a passive way with index investments, things like that. But it's important not to throw all the speculators together, because there are also a lot of speculators that are very short-term market participants, and what they do is they provide liquidity.
Right.
One of the other key important things for commodity markets is risk transfer. Is for the farmer or the rancher to be able to transfer their commodity risk to somebody else. And if you don't have those speculators that are there in the marketplace, you don't have the ability, and what you have is very illiquid markets.
Right.
When you have illiquid markets, people can't manage risk.
And there's nothing worse than not being able to get into a position or out of a position.
Absolutely. And having that liquidity is what allows things to do that. I mean, CME Group has some of the largest, most liquid contracts, and we have that not just because we have commercial participation, but because we do bring investors into the market as well.
So I guess obviously there's more volatility right now in today's market. So do we if we look at the markets on an annual basis, because we have so much more interest in these commodity markets, the highs and the lows, is the range bigger than it normally would be, or?
Well, I think that when you look at volatility, first of all, I think absolute prices are higher. And if you think about what's going on today in the world, we have a demand base that's growing. We have significant increases in demand in China and India, and that really drives back to the situation where as those people become more affluent, they want to move up the food curve. They want to eat less rice, they want to eat more beef. And as that demand occurs, we're tightening up the balance sheets. So one of the things you should look at right now is how tight the balance sheets are. When you have tight balance sheets, you have much smaller carryover stocks, and you have a lot more volatility. So in general, there's more volatility, but what's driving that volatility is a higher level of demand relative to our ability to meet that through supply. Trade has grown significantly over the last 10 years. And what's important is that trade has grown along the curve. It's not just trade in the very front end of the market, it's trade in the back end of the market as well. And what we're seeing, both in terms of our products, in terms of some of the over-the-counter products, is the ability for people to manage risk further out on the curve. So when, if you're a marketer, if you're somebody who's a producer that's working in agricultural products, what you want is the biggest window possible in which to make that pricing decision. The more time you have, the more you can capture the cycles. What we're seeing now is more and more activity in the back end of the futures curve, and we're seeing activity in the OTC markets beyond the futures curve. And what that's doing is it's widening the window over which somebody can manage and market their production.
You just don't have to trade in the current contract.
Exactly. If you're trading in the current contract, you might as well trade in the cash market because you have a very small window. What you really want to be able to do is look at the macro cycles in the market. And if you're a producer, when prices are high, not just sell the nearby, but sell portions on out the curve as well.
So from a farmer or a livestock producer standpoint, do you think it's with all the access we have to information now, the information you provide, third party, is it getting easier to manage risk, do you think, or is it getting more difficult, more complex?
One of the things you have to be careful about is getting trapped in the moment, if you will, where you have such a massive amount of information coming at you and really kind of getting sucked into the micro cycles of the market. What's important, if you're a hedger, is to have a long-term perspective to understand what your cost of production is, to understand what kind of return you need, and to think in terms of getting a return on your business. Okay? The hedgers that are the most successful are the guys that say, this is what it costs me to produce, this is what I can sell it for, this is what the margin that I'm locking in, and do that. The guys who are typically less successful are the guys who are trading the market and trying to pick the tops.
Is that the hedger that thinks he's a trader?
I think the technical term is a spedger.
A spedger?
Yeah.
Yeah, but those are, you have to know what you are, right?
Yes.
Yeah.
And it's a business where you have to have discipline. And producers as a whole are very disciplined on the production side. They're very good about making the right production decisions. They spend a lot of time focused on what hybrid should I plant, or what kind of animals should I be producing, what weight do I want to take it to market. They spend a lot of time on that. What they also need to do is spend an equal amount of time on the marketing side, because some of the time making those investments in time and effort have a significantly bigger payoff than some of the decisions on the production side.
Tim, thanks a lot for joining us today, and good luck with the rest of the show.
Thank you very much, Sean.